The Eternal Student here, and today we'll be breaking down the circular flow of income model and how it works. So the circular flow of income model, as the name suggests, is an economic model that illustrates money flows in an economy. Basically, it is a model of the economy that aims to show how money moves around. To explain how it works, let's look at an extremely simplified version of the model before we look at the final thing. The simple form of the circular flow model starts with only two economic agents: households and firm. Now, households are groups of normal people like you and me who breathe, eat, and sleep. In economists' eyes, we own the economic resources within an economy. Households supply factors of production to businesses that enable them to produce stuff. For example, when people go to work, they are supplying labor to businesses. When your cousin decides to start a new business that will inevitably fail, he is contributing his entrepreneurial skills, or lack thereof. Now, this is not to say that households are the only ones to supply factors of production, as firms can also supply other firms. For example, a co-working space can rent its land to other companies. But let's not worry about this for now, as the circular flow of income only concerns itself with flows between sectors. Now, in return for supplying these factors of production, households earn money from firms. In the case of land, rent is earned. For capital, i.e., when you invest in a company, it's interest. Entrepreneurs earn profit, and for labor, they earn wages. These payments from firms in return for factors of production are also known as factor payments. Finally, households will use the money earned from supplying firms to also spend on goods and services provided by firms. Looking at firms, it's the exact story but just flipped around. Businesses use factors of production to produce goods and services. In return, they remit factor payments to households, and they earn revenue from selling the goods and services they produce to households. Plotting this in a nice diagram, we can show where the circular flow of income gets its name from. You can see that every time money leaves the households, the firms earn it, and vice versa. Now, this is a simplified version of the diagram done. Let's move on and add some more stuff to it to get the more complicated version. To do that, we'll need to introduce the concept of injection and leakages. Injections are flows of money that enter an economy, and leakages are flows of money that exit the economy. Now, how might money enter or leave the economy? Well, it might do so through some new economic agents we'll introduce. First of which is the government. When the government spends money, it will pump money into the economy. For example, if the government spends money on building a new hospital, it will purchase the land and hire construction crews, doctors, nurses, etc. But in order to spend money, the government must get its money somewhere. And to do that, it must tax people. Through taxes, governments earn revenue, and in the process, remove money from the economy. The second agent to take note of is the financial sector, comprised of banks and other entities such as investment funds and real estate firms. The financial sector will invest into businesses, injecting money into the economy. It also helps households save their money through banking institutions, and by doing so, removes their money from the economy, at least until it is accessed again. Finally, we have the foreign sector. Through exports and imports, money can enter or leave the economy. When your country exports goods abroad, it earns revenue from foreigners who buy those exports. And when you buy foreign goods, you are effectively paying the people in the country who made those goods. We can represent each of these injections and leakages and how they will affect the circular flow of income by putting it all together. Starting from the simple version of the model with just households and firms, let's add all of those entities we just mentioned. Then we draw each leakage from the household sector feeding to each of its respective entities, so taxes for government, savings for the financial market, and import expenditure for the foreign markets. Likewise, we can also draw each of the injections from each entity, feeding back into the firms. Government spending from the government, investment from the financial sectors, and export revenue from the foreign markets. And with that, we're done. Now, those astute minds among you watching this video might be saying, why do leakages only come from households? Don't corporations pay tax too? And you'd be completely correct. This is indeed a very simplified representation of things in the real world. There are a lot more flows and factors we haven't included, but at least for the IB level, this is good enough for now. Just from this simple model alone, we can infer that when injections are greater than leakages, more income will be in the economy overall, and so this represents economic growth. Likewise, when injections are smaller than leakages, more money exits the economy, and so the economy has less income overall and will decline. From this logic, we can understand that anything that impacts the relative sizes of injections and leakages will affect the growth of the economy. We'll revisit this concept once we start studying government policies such as fiscal and monetary. Now, for a fun fact that won't be tested at all in the IB syllabus, you can skip this part if you're not interested. But basically, there's a machine out there that actually uses water and fluid dynamics to simulate the flows of income within an economy. It's called the MONIAC and was invented in 1949 when computer modeling wasn't even a thing yet. Using the MONIAC, one could adjust the pumping speeds of the flows that represented injections and leakages to simulate what would happen in the economy.
It's one of the first macroeconomic computers. It was built in the 1940s.
It is a computer. It's hydromechanical.
It's a model of the macroeconomy, so the economy as a whole.
Bill Phillips created one of the most extraordinary economic tools that was created in the mid-20th century.
So this machine here is going to show how water flows around the economy, or how money flows around the economy. We have this income tank down here, and this is water flowing up into the machine as income. Before the income reaches households, some of it is taxed, and for the government, this is income. So taxes flow down here as income to the government, then the government decides how much it would like to spend.
Okay, the optional fun fact is now over. Welcome back to those who skipped forward and refused to learn against their will. It's time for the syllabus statement review. Now, in my experience, the circular flow of income model is a bit of a baby-faced killer. A lot of students seem to forget about it completely and are surprised to encounter it when it reappears in the exams, often as a paper 110 marker. So do make sure you know it well, including all the different entities inside the model, the definitions of things such as factor payments, and how injections and leakages will affect the economy. Now, the IB syllabus statement again makes this huge song and dance about one of the 9 key concepts, interdependence, but you don't need to worry about this. Finally, in paper 2, and for those of you taking paper 3, do expect the possibility of being confronted with a diagram of the circular flow of income model, and being expected to interpret it or do simple calculations. And with that, we're done! You've been watching The Eternal Student, thanks for watching, and as usual, I'll see you next time.